Hi, everyone. In this class, we are going to talk about plant assets, natural resources, and intangible assets. And those are very important kinds of our firm's long-term assets. And so let's first start from talk about plant assets. What are plant assets? The formal definition of a plant asset is its resources that have, first of all, have physical substance and are used in the operations of the business, are not intended for sale to customers. So if a firm, for example, Target holds some inventory that is intended for sale to customers, those are called inventory. Those are not plant assets for the firm. On the other hand, if Target has a physical store somewhere, and that store is not for sale, Target's business is to sell its inventories, not to sell the store. So the store is one kind of the plant asset for Target. Yeah, that is the definition of plant assets. And plant asset is also called property, plant, and equipment. So that's PP&E, plant and equipment, fixed assets. So wherever you say any of those, like fixed asset, PP&E, you should understand that they refer to the same thing. They're all plant assets. Why are plant assets important? So here is some simple statistics about plant asset as a percentage of the firm's total asset. And as you can see here, that depends on the industry the firm is in. For some industries, it's really important. For example, for Wendy's, 73%, JetBlue Airlines, plant assets. So can you imagine what is JetBlue's plant asset? So for JetBlue, they have those airplanes. And sometimes depending on how those airplanes are classified, if JetBlue bought those airplanes, those are JetBlue's plant asset as well. Walmart stores, Nordstrom. So for those firms, plant assets can be a very important part of its total asset. So that's why we need to know how to account for plant assets in general. And what are the major classes of plant assets? So there are three major classes of plant assets. The first is land. If the firm owns a piece of land, that is classified as a plant asset. The second kind is called land improvements. So what are land improvements? For example, if a firm has driveways, parking lots, fences, landscape, underground, sprinklers. So those are structural additions with limited life that are made to land. Those are called land improvement. And those are classified as plant assets as well. If the firm has any buildings are classified as plant assets, and as well as equipment. So if Starbucks has any coffee machine, those are classified as equipment, which is one kind of plant asset. So let's talk about the major accounting issues. This is our accounting class. And what are the accounting issues that can come up with regard to plant asset? So with regard to a plant asset, there are usually three accounting activities that may happen. The first one is when the firm purchased that plant asset, how do accountants account for it? The second one is subsequently, after the firm has purchased that plant asset, subsequently, the firm may decide to spend more money on that plant asset. And then they also need to do the depreciation. Depreciation is a cost allocation process. So they need to, when they do the purchase, accounting, if it is classified as a plant asset, we need to capitalize it on the firm's balance sheet. And then subsequently, it's going to be depreciated into the firm's income statement gradually. So let me just, in order to make this concept clearer, let me first talk about here, just do a little bit detail, talk about there are two important concepts in accounting. One is called capitalization. The other is called expense. So what is capitalization and what is expense? whenever the firm spend money buying something, so they spend money purchase something, they spend money and they get something. There are two kinds of possible accounting treatment for it. One accounting treatment is, so they're going to credit cash because they spend money, and then they are going to put it as an asset on the firm's balance sheet. So for example, they're going to debit PP&E. And as you can see here that this journal entry, it has no income statement impact. Here, it doesn't affect the firm's net income during the year. So this is one way to treat it. This is one accounting treatment the firm can have when they purchase something. The other accounting treatment is, so they're spending cash. However, they can debit some kind of expense directly. And if they go this way, it's going to impact the firm's net income of the year. It's going to go down. It's going to impact the firm's income statement. So the first way is called capitalization. The second way is called expense. And the firm can choose between those two. Usually, when the benefit of whatever the firm purchased, the benefit is for the future. So, for example, in the PP&E situation, the firm may purchase a machine, and the benefit of the machine is probably going to benefit the firm for 5 years. So of course, when the firm purchases it, the firm hasn't used it yet. It hasn't generated any benefit for the firm. Of course, if the machine is, for example, $10,000, it doesn't make sense to put all of those 10,000 in time zero before the firm even get any benefit from using this machine. So it doesn't make sense. So what the firm does is it's going to capitalize it on the firm's balance sheet first. And then in the next 5 years, when the firm is using it to generate profit, it's going to allocate the cost of this $10,000 gradually over these 5 years. It's going to be recognized into the expense during those 5 years in the next 5 years. However, so for expense, it is usually the benefit of this, whatever this cash outflow, it is to only benefit for the current period, or it can be very immaterial that it just doesn't, when anything is immaterial in amount, it just doesn't matter that much for the accounting treatment. So that is when the firm may do the expense. And then, for example, if the firm, for example, spend money, purchase some, maybe a pencil, which the firm is going to use in the current period, it's just going to expense it directly into it's going to impact the firm's current year's net income. So that's capitalization versus expense. And then in the PP&E situation, because that fixed asset, that long-term asset, is going to benefit the firm for multiple periods. So what the firm usually does is it's going to capitalize it on the balance sheet as PP&E. And then in the future, in the next few years, it's going to expense it gradually into the expense. And this process of allocating cost in the next 5 years into expense, this is called depreciation. However, if the firm decides to just expense it directly in the current period, they don't need to do any depreciation because it's already expense. So it's already reflected into the firm's net income. There's no need for for depreciation anymore. So in this situation, there's no depreciation. Yeah, so this is just two very simple but important concepts in accounting: capitalization versus expense. And then let's come back to talk about plant asset, because plant asset is a long-term asset. The benefit of this asset is going to benefit the firm for multiple years into the future. So when the firm purchases this asset, they don't debit any expense. they're going to capitalize it on the firm's balance sheet. And then depending on how the firm purchased this asset, it can be either credit cash or account payable. And then the important accounting issue here is not regarding this journal entry. The journal entry is very simple: debit PP&E, credit cash, or account payable. But the really important accounting issue here is determining what is the amount to debit or credit, or in other words, how to determine the cost of this PP&E, this planned asset. So this is the first accounting journal entry here, which we make when the firm do the purchase. And subsequently, the firm may spend more money on this asset. So depending on the nature of this spending, the accounting treatment is going to be different. And then another issue here is depreciation. So here in this journal entry, we haven't recognized anything into the firm's expense yet. It's going to be recognized gradually in the subsequent period through depreciation. And the journal entry is to debit depreciation expense, credit accumulative depreciation. This account, accumulated depreciation, this is a contra account to PP&E or to planned asset. So it's going to decrease the net PP&E of the firm. And then after the firm has used this asset for a while, they may need to decide to how they're going to dispose this asset. And then there are different ways to do this disposal. We're going to talk about it in a minute. So let's first look at the first journal entry: debit PP&E, credit cash, or account payable. And then, as we just talked about, the really important question here is how to determine the cost of this planned asset. So in order to determine the general rule here for determining the cost of planned asset is, we use a historic cost principle. What is historic cost principle? We require companies to record planned asset at cost. So what does cost consist of? Cost basically consists of all expenditure necessary to acquire the asset and make it ready for its intended use. So for example, if the school purchased a projector, what is the cost? So the journal entry is to debit PP&E, credit cash. But the question is, how much to debit for PP&E for this projector? And the projector by itself may cost only, for example, $400. However, in order to get this projector here, in a condition that can be used by us, the school may need to spend some shipping cost, like $50 shipping cost. And then when the school purchase this projector, they may pay another $100, maybe not that much. So maybe $40 sales tax. And then once the projector arrives, the school may need to hire someone to install this projector and to test it. So this may cost some additional money. And so what is the cost? Which number should we really put into, should we debit for the cost of this projector? And according to the rule here, it's actually all of the expenditure. So not only the real price of this projector, but the sales tax, the shipping cost, the installation fee. So all of these expenditures necessary to acquire the asset and make it ready for its intended use should be included, should be capitalized into the cost of this projector. So this is just a simple example. And then let's look at what are included in the cost of different kinds of PP&E. So the first one is land. The cost of land should include the cash purchase price, closing costs, title, attorney fees, real estate brokers' commissions, accrued property tax, expenditure for cleaning, draining, filling, so all of those. And if there's a building that needs to be removed from land before construction of a new one, so all of the removal cost, less any proceeds from salvage material. So those are all of those should be included into the cost of the land. And let's look at an example here. So please take 5 minutes, read this example, and you can pause your video for now. So what is the cost of this land? The firm spent a cash cost of 100,000, and it has an old warehouse, so raised at a net cost of 6,000. Additional expenditures are attorney fees, real estate broker commission. So what is the cost of the land and what is the journal entry? So the answer here is 100,000, the real cash cost should be included. 6,000, the cost of removing this old warehouse should be included. Attorney fee, 1,000. And then real estate broker commission, 8,000. So all of this should be included into the cost of the land. And the journal entry is for debit land, credit cash. So this is how to calculate the cost of the land. Let's then look at how to calculate the cost of buildings. So the cost of building is actually very similar: purchase price, closing cost, real estate brokers commissions, expenditures for remodeling, replacing, repair roofs, floors, all of those. And if the firm decides to construct a new building, contract price, payment for architect's fee, building permits, so all of those should be included into the cost of the building. The next one, cost of equipment. So cash purchase price, sales tax, shipping cost, insurance during transition, insurance during transit, expenditure required in assemble, install, testing the equipment. But one thing that you should pay attention is if that equipment, it can well be a motor vehicle. And in that situation, what is not included, we shouldn't include the motor vehicle's license fee, accident insurance on the vehicle. So those two items shouldn't be included because that's usually just for the current period. It's not for the benefit of multiple periods. And let's look at an example here. So the firm purchased a delivery truck. The cash price is this amount. Related expenditure, sales tax, painting, littering, motor vehicle license, 3-year accident insurance policy, and please compute the cost of the truck. And what is the journal entry? So please take 5 minutes. You can pause your video for now. So in this situation, the truck has a cash price, and this should be included. The sales tax should be included. The painting and littering, this should be included. However, the motor vehicle license fee should not be included. And the 3-year accident insurance policy should not be included. So this should not be included into the cost of this motor vehicle. However, it actually it should be. However, it should not be counted as an expense either. So, and then the question is, how should we classify this 3-year insurance policy? Please take 1 minute to think about this. So as we just said that 3 items should be included. And for this insurance policy, this should be classified as a prepaid insurance. This is as what we actually talked about it previously. It's just like prepaid rent, prepaid insurance. So yeah, because it's a prepayment, it's prepaid for 3 years. Yeah, so and the journal entry is for debit equipment, debit license expense, debit prepaid insurance, and credit cash. So we have talked about how to calculate the cost for PP&E. And then next, so in the subsequent periods, the firm may decide to spend some expenditure, some more money on this PP&E. And depending on what is the nature of this spending, so it can either be a revenue spending or it can be a capital expenditure. So revenue expenditure or capital expenditure. And what are revenue expenditure? Those are usually expenditures to maintain operating efficiencies and productive life of the unit. Those are usually pretty small in amount and they occur frequently. And then the general entry for this is we debit expense and credit cash or account payable. So in general, the idea here is because it's small in amount, it occurs frequently. So we just expense it directly into the firm's income statement. Versus if it's a capital expenditure, which are expenditure to increase the operating efficiency, productive capacity or useful life of the unit. So those are usually material in amount and occur infrequently. Those are classified as capital expenditure. And the general entry here is to debit PP&E, credit cash, or account payable. So in other words, here we just added to the cost of the PP&E. So those are two kinds of expenditures, how we account for it differently. And besides subsequent expenditures, another issue which may come out is if the firm decides to capitalize that asset on its balance sheet, it needs to eventually go into the firm's income statement gradually. And the way to do it is called depreciation. So depreciation is a process of allocating to expense the cost of a plant asset over its useful life in a rational, systematic manner. And one thing to you should really remember and pay attention is depreciation is basically a process of cost allocation. And of the 4 kinds of plant asset we just talked about, when 3 of them are depreciable and 1 kind, which is plant asset, it is not depreciable. In other words, we do not depreciate land assets, but the all other 3 are depreciable. We depreciate them. So please take 5 minutes, try to think about why. Why do we not depreciate land asset? You can pause your video for now. So why do we not depreciate land, whereas we depreciate building, we depreciate equipment, we depreciate land improvement? And the answer is, if you think about all of the other assets, so if Starbucks has a coffee machine, it has used coffee machine for maybe 5 years, 6 years, or even 10 years. And eventually that coffee machine is going to become not usable anymore. Versus a piece of land. So in other words, for those assets, the value of the asset is going to decrease gradually over time. However, for a piece of land, if the firm has a piece of land, does the value of the land go down over time? Not necessarily, right? And actually, in most of the situation, the value of the land is going to appreciate, go up over time. So it just doesn't make sense for the firm to depreciate land when its value doesn't really go down over time. So that's why we do not depreciate land. And in computing depreciation, usually 3 factors plays a role here. One is the cost. What is the cost of the asset? And this cost is what we just calculated. The second important factor is the useful life, or we call it service life of the asset. So for example, a car can maybe be used for 10 years. A building may be used for 50 years. So something like that. And the last factor is called salvage value. It is also called residual value. So it's basically after the asset reach the end of its useful life, if the firm decides to sell it, how much salvage value the firm can get from selling this asset. And the difference between cost and salvage value, that is called depreciable cost. And this is what depreciation is based on. So basically, we call it depreciation is a cost allocation process. And what cost do we allocate? we allocate this one, the difference between cost and salvage value. And then, yeah, so as we just talked about here, useful life, cost is what we calculated previously. And then the useful life, it can be either in terms of time, like maybe 10 years, or it can be in terms of units of activity or units of output. So for example, the useful life can be, a car can be driven for 100,000 miles. When this 100,000 miles, it can be another way to put the useful life, the service life of the car, which is in terms of units of output or units of activities. And then the third factor is the residual value. So how much is the asset's value at the end of its useful life? And so we have talked about the three factors: cost, useful life, and salvage value. And when we do the depreciation, the amount that we depreciate every period, it not only depends on the cost and salvage value and useful life, it also depends on how are we going to allocate the cost among those among the useful life. And there are more than the cost, the depreciation, and this is the how. So how are we going to allocate this cost? This is called depreciation method. And there are more than these three depreciation methods, but here we only talk about three. The first one is called straight line depreciation. The second is called units of activities. The third is called declining balance. And as you can see here, that straight line depreciation is the depreciation method that is most often used. So let me, in order to explain what's the difference among these three depreciation methods, let's just look at an example here. So suppose the firm purchased a small delivery truck. The first year, the firm drove its delivery truck 15,000 miles. The cost is 13,000. Expected salvage value 1,000. Estimated useful life 5 years. Estimated useful life in miles, that's 100,000. And then we have three ways to do the depreciation. Please compute the first year depreciation. I'm going to give you 5 minutes. Please try to figure out what are the first year depreciation under each of the three methods. And you can pause your video for now. So the first year depreciation under the straight line method, basically the cost is 13,000. The salvage value is 1,000. So this is the depreciable base. And we just allocate it evenly over 5 years. So each year that's 2,400. And then, so as you can see here that each year 2,400. And at the end of the 5th year, the we start from depreciable cost. Depreciable cost is 12,000, but our starting book value is 13,000. So after the first year, the firm depreciated 24,000. So the book value, the net book value that is left becomes 10,600. And then the second year, we depreciated another 2,400. So the net book value goes further down to 8,200. And at the end of the 5th year, our net book value is 1,000, which should be equal to the salvage value of the asset. So this is the straight line depreciation. Basically, we allocate our depreciable cost evenly over our useful life. The second method is called units of activities method. So basically here, we allocate this depreciable cost over the total units of outputs. So the car can be driven for, the total useful life in miles is 100,000. And then the first year, the car was driven for 15,000. So we multiply it by however it's used in the first year. and this gives us 1,800. So as you can see here that the depreciation each year, depending on how much the unit of activity, how many miles are driven. And then in the end, similarly, we are going to depreciate it, all of our depreciable cost. And then what is left is the salvage value. So this is the second way, unit of activity method. The third way, double declining balance method. So a double declining balance method is one way to do the declining balance method. We can do double declining, we can do triple declining. And what we're doing here is we first calculate what is the rate of depreciation under the straight line method. So for example, here in this example, what is the rate of depreciation under straight line? So our useful life is 5 years. And if the firm is using straight line method, every year, the rate of depreciation is 20%. And then double declining, basically, we multiply it by 2. That's double declining. If the firm is using triple declining, we multiply it by 3. So in this situation, we want to know the double, what is the firm's depreciation and the double declining. So we multiply it by 2. And then this is going to give us 40%. And then what we do is we don't start from our depreciable base. We start from the cost. So you please pay attention here. This is not 12,000. This becomes the cost, 13,000. And we multiply it by 40%. The depreciation rate we just calculated. And then we're going to get the annual depreciation expense for the first year. So the cost minus the first year depreciation, we're going to get our net book value of 7,800. And then the second year, we start from 7,800, which is the new net book value, multiply it by 40%. We're going to get second year depreciation. So as you can see here, that why is it called declining balance method? Basically, this is a method which will enable us to recognize more depreciation in early years and less depreciation in later years. And one thing to pay attention here is under this depreciation method, because we don't try to allocate our depreciable cost over a certain period, over our useful life. We start from the cost, and then we just multiply it by arbitrary, some kind of arbitrary depreciable depreciation rate. But this depreciation rate, it should be more than the straight line depreciation rate. Otherwise, it's not going to, we're not going to have a declining balance. So the last year, it's not, because we are doing this, it's not guaranteed that we're going to arrive at an amount which is exactly equal to our salvage value if we just do this for every of the year until the end of the 5th year. So what we need to do in order for our ending amount to be equal to the salvage value is in the last year, this amount, 685. This is not calculated by taking the last year beginning net book value, multiply it by 40%. Instead, this is a false number. So whatever number is needed to force it to our salvage value, we're going to take it. So this number is, we use 1,685 minus the $1,000 salvage value. And this is going to be our last year's depreciation expense. So this is the double declining method. And here's a summary of the 3 methods. As you can see here that under the double declining balance method, we're recognizing more depreciation in early years and less depreciation in later years. Versus straight line methods, depreciation is the same across years. Unit of activity method, it depends on how many activity you have across years. So different depreciation methods is going to give us different depreciations over years. But one thing that is worth noticing is no matter what kind of depreciation method the firm choose, overall, if you sum up the total depreciation expense over its useful life, it's going to be the same. So total depreciation expense is the same across years. The only difference is the timing difference. When are you going to recognize that depreciation expense? So this is depreciation. And we have talked about how to account for the purchase of PP&E and subsequently how to account for depreciation and subsequent expenditures. And then the next question about PP&E is disposal. So after the firm has used that PP&E for a while, there's 3 ways a firm can get rid of that PP&E. The first is called retirement. So it's just retired. The firm is not getting anything back. The second way, the firm can just sell it and get something back. The third is called exchange. So the firm may decide to exchange it for something else. For example, exchange an old machine for a new machine, and the firm is going to pay some additional money for that. And in this class, we're going to talk about retirement and sale. And if you choose to take some more advanced financial accounting class, for example, Accounting 301, they're going to talk about how to account for exchange in that class. Let's first look at retirement. So here's an example. Suppose the firm retire a computer printer which cost 32,000. The accumulated depreciation is 32,000. And then what is the journal entry to record this retirement? So the journal entry is very simple. Whenever the firm retire or get rid of something, they need to just write off everything associated with that PP&E from the firm's book. So in this situation, what is associated with this PP&E? The cost is 32,000 and accumulative depreciation 32,000. So basically, the firm just write it off. Everything goes to 0. So in order to write it off, the firm credit PP&E 32,000 and debit accumulative depreciation for 32,000. And that's the journal entry. So this is a very simple example about the retirement of PP&E. And let's look at another example. So suppose now the cost of this equipment is 18,000 and accumulative depreciation is only 14,000. And then the firm decide to retire this PP&E and not get anything back. So basically in this situation, we write off everything associated with this PP&E from the firm's book. And now one question comes out, the journal entry is not going to be balanced. So what we do here is, depending on where is the imbalance. So in this situation, obviously the imbalance is at the debit side. We need to debit 4,000 more. Basically, this PP&E still has a net book value of 4,000, but we're just discarding it, not getting anything back. So this is a loss on disposal of PP&E. Now let's look at how to account for the sale of PP&E. So here is an example. The firm sell the office furniture for 16,000 cash. So basically, the firm get cash 16,000. And then for this firm furniture, the original cost 60,000. So the original cost is 60,000. And it had accumulative depreciation of 41,000. Depreciation for the first 6 months is 8,000. And the firm disposed this asset after the first 6 months. So we need to take out, recognize the first 6 months depreciation. So after this, the total accumulative depreciation at the time of sale becomes 49,000. And what we need to do is to write off the cost of 60,000 and also to write off the accumulative depreciation 49,000. And then is this journal entry balance? No, it doesn't. Where is the imbalance? It's 5,000 at the credit side, and this is a gain on disposal. Or you can understand it as the net book value of this PP&E is 11,000. However, the firm gets 16,000 by selling this PP&E. So the firm actually gained 5,000. So it's a gain for the firm. So here, basically, the firm needs to first make a journal entry to account for the first 6 months depreciation expense, and then to record the sale. Let's look at another example about the sale of PP&E. So just now we looked at a situation when the firm make a gain from selling this PP&E. And now suppose that instead of 16,000, the firm sell it for 9,000. What is the journal entry? So now the journal entry is, if the firm sold it for 9,000, the imbalance is going to be on the debit side of 2,000. And this is a loss on disposal of PP&E. So basically, the net book value of PP&E is 11,000, and we sold it for 9,000. So the firm lost 2,000. It is a loss for the firm. So now we have talked about all of the accounting journal entries for PP&E. Let's look very briefly about natural resources. What are natural resources? Natural resources consist of standing timber, underground deposits of oil, gas, minerals. And those are usually physically extracted in operations. And they are replaceable only by an act of nature. So this is the definition of natural resources. And with regard to natural resource, there's also the question of how to calculate the cost and how to calculate the subsequent allocation of cost. So first of all, how to calculate the cost? It's very similar to PP&E. So it's the price needed to acquire the resource and prepare it for its intended use. And then subsequently, after we have capitalized this natural resource on the firm's balance sheet, we need to do the cost allocation subsequently. So how to do the cost allocation? The process of allocating the cost is called depletion. And then usually the firm use units of activity method to compute depletion. And the journal entry is to debit inventory, credit accumulative depreciation. Because, for example, you can imagine that an oil and gas company extracted some of its natural resources from under the ground. And then this become an inventory for the firm. So the firm is not going to use that oil in some operation to generate any future benefit. Instead, that oil is extracted for future resale. So that's why it's an inventory for the firm. And that's why we debit inventory, credit accumulative depletion. Yeah, so this is about natural resource. And another point is, so just now we talk about why is it debit inventory? And another point is, you may also wonder, why do we not debit any kind of expense? Because now the gas is, or the oil is extracted, but that becomes the firm's inventory, another kind of asset. The firm hasn't sold it yet, so it has nothing to do with expense yet. So we just talked about PP&E and natural resource. The third kind of important long-term asset we're going to talk about is called intangibles. And the major difference between intangibles and the previous two kinds of assets is it does not have any physical substance. So it's intangible. But on the other hand, it is also a non-lived asset. So it is right privileges, competitive advantage that result from ownership of long-term asset. But the key here is it doesn't have any physical substance. And so with regard to intangibles, it's two very similar questions: how to determine the cost of intangible and how to do the subsequent cost allocation. with regard to how to determine the cost of intangible, it's very similar to what we talked about before. All expenditure necessary for the company to acquire that asset, that's included in the cost. But one thing to pay attention is, if this intangible is developed internally, for example, it's developed through R&D, those are usually expensed. So we don't put R&D as the firm's asset. The reason is usually because the benefit of those R&D expense are highly uncertain. We don't really know. R&D, if you look at those pharmaceutical companies, those money spending R&D, it has a very high likelihood that it's going to fail eventually. So because of the uncertainty of the benefit of R&D, and also because of this, it is very hard to quantify what is the benefit of R&D. So that's why we usually just expense those R&D as they incur. So for those internally developed intangible, we expense those. However, if an intangible is purchased from outside, we usually capitalize those intangibles on the firm's balance sheet. And the process of cost allocation for intangibles, that is called amortization. If an intangible, it can either has finite useful life or indefinite useful life. If an intangible has indefinite useful life, it is not amortized because we don't know what is the useful life. So it's impossible to calculate amortization expense. And companies, they usually use the straight line method to compute amortization. The journal entry is to debit amortization expense, credit intangibles. So that is the journal entry. And lastly, I want to talk about the major types of intangibles and their associated useful life. So patent is one kind of intangibles. The legal life of a patent is usually 20 years. Copyright is another kind of intangible. The legal life of copyright is the life of the creator plus 70 years. Trademark, trade names. So for example, firms like Apple has a trademark, trade name. And then the legal life is 20 years, but it's renewable indefinitely. So for accounting, for trademark, accountants think about trademarks useful life as indefinite because the firm can just keep renewing its trademark indefinitely. So that's why for trademark, we don't amortize trademark. However, for patent, for copyright, we do amortize those. Franchises, the legal life for franchises, it depends on the contract between franchisor and franchisee. So it just depends. And then another kind of very important intangible is called goodwill. What is goodwill? If you choose to take some more advanced financial accounting, they're going to talk about goodwill more in depth. But here, I just want to give you a very brief summary of what goodwill is. Goodwill is basically if a firm, for example, if I want to go buy an ice cream shop, and I look at all of this ice cream shop, what do they have? They may have some ice cream machines. They may have some desks. They may have some chairs. They may have a trademark. So ABC ice cream. It's trademark here. They may have a building. So they may have some recipe even, which is intangible. But if I go to this firm to identify everything I can identify, and I assign a value to all of those, and then I add them up, it may only give me, for example, a valuation of $1 million. However, for some reason, I'm willing to pay 1.5 million to buy this ice cream shop. Why am I willing to pay $1.5 million to buy something that I can only identify $1 million? It can become a lot of different reasons. I may think that by buying this ice cream shop, it works so well with my current business that we're going to have some synergies. Or I may think that this ice cream shop has it's going to, if I don't buy it, it's just going to grow so big. It's going to be my major competitors in the future. So it's going to just worth far more. Like in the future, it's going to be a threat to me. Or I may think I may just like the management of this ice cream shop. So I'm willing to spend like 0.5 million more to buy it. So, and it all may just be, I'm just, for some reason, I just want to overpay for this ice cream shop. It just be overpayment. It can be a lot of different reasons, but just for some reason, I cannot really identify what reason it is. And the fact is, I'm just paying 1.5 million for something, which may only worth 1 million. And the difference between this 1.5 and 1 million, this 0.5 million, this is called the goodwill. Goodwill is the only unidentifiable intangible of the firm. The firm cannot really identify it. And this only appears when the firm has done an M&A. It has go buy some other business, and it is paying more than what is the sum of the identifiable as the sum of the fair value of the identifiable asset of that firm. It is only in that situation is the firm going to have goodwill on its book. And in all of the other situations, there's not going to be any goodwill. So this is what goodwill is. And we talked about plant asset, natural resource, and intangibles. And here, let's just look very briefly at how those are reported on the firm's balance sheet. So usually firms combine plant asset and natural resource under PP&E. Natural resource, those are usually combined into the PP&E of the firm. However, those two, plant asset, natural resource, they are reported separately from intangibles on the firm's balance sheet. So this is usually like how those are reported on the firm's balance sheet. And actually, in most of the situation, the firm on the firm's balance sheet, it is reported more simple than this. It's only going to report, for example, PP&E for this amount and the intangibles for this amount. It's not going to tell you the details. If you want to know the details, look at the note of those financial statements. So, however, this example is giving you some details here. But the bottom line is plant asset, natural resource, those can be combined, but they need to be separately reported from the firm's intangible assets on the firm's balance sheet. So this is all I want to cover for this chapter.